How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. And today's topic, I want to discuss with you annuity withdrawals explained for dummies, and explain how annuities were first created, what some of the really bad things about annuitization brought about regarding the negative viewpoint of annuities, and then how someone could leverage more of the innovative type of annuity products for retirement income, at that later date or instantly, whatever the case may be. So essentially, if we kind of take a step back, annuities were originally created to counteract life insurance. What do I mean by that? Well, with life insurance, an individual would pay premium dollars on either a monthly basis or an annual basis, year by year. And God forbid if that person was to pass away, was to die too soon, they would have a lump sum death benefit get paid out tax free directly to the beneficiaries. So that's exactly how life insurance works. Basically, someone would go have life insurance on their own life or them and their spouse, and make sure if they pass away, then their children are covered, or their spouse and their children are covered, or family members, whatever the case may be, depending upon that life insurance goal. Annuities are the complete opposite of that. Essentially, what's happening is individuals understand that people are living longer, that people are running that risk of outliving their monies, so they want to have some sort of safety and some sort of guarantee that they could be receiving a lifetime income stream, kind of like how a pension works, but more on the personal side. So when annuities were first created, you had individuals, and this is still prevalent today. They still have these types of options today, or should I say, where someone could go to an insurance company. Only insurance companies are the ones that are able to offer annuities. So that's why you can't have a bank that's offering an annuity. You could have a bank that's offering an annuity, set up through an insurance company, but you're never going to actually have a bank that does it. Just like an insurance company can't offer a bank CD. There's two separate intervals, two separate product lines, two separate legal reserve structures, set up for those two types of contracts. So what would happen was an individual would go to, the insurance company up the street, or just go to a random insurance company and say, I want to have that, I want to eliminate that risk of outliving my money. So this insurance company would say, okay, if you give us X amount of thousands of dollars, so we'll just use an example of $100,000, and let's say this person's 65 years old, this guy leverages his $100,000, the insurance company now holds onto the money, and based upon their mortality tables, meaning their statistics that that person is going to pass away, they're going to have some sort of percentage, some sort of calculation that's determined that states, okay, we're going to make sure to pay you $7,000 per year until the day you die. Now, the bad part about the good part is this person could be living and living and living and living and living. Let's say he lives into his 80s, his 90s, his hundreds. He's still getting $7,000 every single year, and all it did was cost him $100,000 to do so. So that was known as annuitization. You're annuitizing your money. You're surrendering full control, full access to this $100,000, and this person was surrendering full access to that $100,000 to then receive a systematic stream of income that would last for either his life or his and his wife's life, or vice versa, spouse. So understand, if an insurance company is making an offer on an individual's life, they could give a higher rate of return, a higher dollar amount, because from their perspective, the risk is going to be minimal. They only have to insure essentially one life. They only have to predict, on a mortality rate speaking, one life on how to pay out that that lifetime income. So if somebody's looking for joint lifetime income, and let's say you have a male age 65, a female age 65, and they want to now take $100,000 and make sure that it's going to come to be covered on both of their lives, well, maybe that benefit might be $5,000 if they want to turn on income immediately. So the reason being why that's that $2,000 gap, per year, is because there's a larger risk to the insurance company's book. So therefore, the insurance company is going to place that risk onto the insured, onto the annuitant or the annuitants. So with that aspect, individuals would go and place their money into annuity with the hope that they're going to live a nice, long, prosperous life, just like everybody else does. Now, the downside to it was, with annuitization, this person is surrendering their money. They're surrendering the $100,000. If, let's say, this male who's age 65 years old goes and he, only lives for 2 years and he got paid $7,000, well, he would have got paid $14,000, and let's say, God forbid, he passes away, the insurance company would keep $84,000 of pure profit. So insurance companies understand that mortality table. They have hundreds of years worth of data depending upon the company that you go with, but they understand exactly those annuitization routes. So they're going to try to position their product lines to leverage and say, hey, listen, let's incentivize somebody to annuitize your contract, because they want you to ultimately surrender control of your money. So what they're doing is they're taking your $100,000 and they're investing on the back end, making money to therefore churn a profit. And they also, with people that fall victim to that annuitization aspect, they lose full control. Maybe you might have the one guy that out of every 10 people that are placing $100,000 into their product, maybe you might have 2 or 3 of them that are outliving that break point, while you have 7 of them that are not. So therefore, the company's making money off of your money, and they're also netting off whatever that profit is, that is not being left to your beneficiary. So this is where you started having more innovative processes or more innovative product lines with the different types of annuity contracts out there. Back in the 80s and 90s, individuals were able to leverage something known as a bank CD, which is nothing more than a type of fixed account, and use that as an interest-only withdrawals for retirement income. Well, what happened was, because you had interest rates that were so high, you had bank CDs that were paying 8, 9, 10% with very short-term bank CDs. So you could have somebody that has, let's say, a 5-year bank CD that's paying them 10%. They could go leverage that same $100,000, place it in with a bank, make sure that it's secure, it's protected because of their legal reserve structure, and therefore they're getting $10,000 every single year for 5 years, and after the 5th year they walk away back with that $100,000. So then you had annuities that tried to mimic that bank CD route and give individuals a larger incentive to go with the insurance company and go through something known as a fixed annuity. So the incentive of the reason why someone would go to a fixed annuity would say, okay, well, if a bank CD is paying 10%, our fixed annuity might be paying 12%, or fixed annuity might be paying 14%. So it has its own slew of legal reserve structures as well, making sure that's a very safe contract. And then someone could do that whole laddering process as well to live off of that interest only. After the 5 years were met and you're getting paid $12,000 per year, then that person would be able to walk away with $100,000, or then roll that money over into the next best fixed interest rate. So that's essentially a very simple way on how individuals were able to leverage these types of fixed accounts and live off of the interest only while still preserving their principal, throughout the entire process. So then individuals thought that they could just leverage that aspect, throughout their entire retirement years and just have that fixed interest rate year by year. It would be a very simple strategy. You could set up with multiple types of things, such as like a 3-year CD, a 5-year CD, a 6-year CD, etc., or 5-year, fixed annuity, 3-year fixed annuity, whatever the case may be. Now, what the problem lies is that interest rates have now hit all-time lows. So instead of a bank CD paying 10% or a fixed annuity, paying 12%, you now have a 5-year bank CD that pays about 1%. You have a 5-year fixed annuity that's paying 3% because it's all tied to treasury bonds and then the different treasury rates. So obviously that's a problem there. So individuals can't necessarily leverage that type of interest aspect that they once were able to do. So then what happened was after that started occurring, after interest rates started dropping slowly in the later, in the mid 90s, later 90s, early 2000s, you had individuals started gravitating towards investments and types of variable accounts to supplement their retirement income, or try to have something that's going to gain money. And let's link it to the stock market so that I could always, as long as the market's always going to be going up, I could pull out that amount of money that's being gained that year, live off of it for income, and then leave an inheritance to my beneficiaries, or never really dip into my principal. And it's been disproved time and time again. There used to be something known as a 4% rule that said as long as you leave your money in variable accounts and conservative mutual funds, there's about a 90% chance of you not outliving your money. So the downside to that is whenever the market actually goes negative, you comes into contact with something known as reverse dollar cost averaging, which is a combination of fees, downward market loss, and pulling from these accounts that have turned this entire 4% rule upside down. So you have these different things of individuals understood the negatives regarding annuitization, individuals understood the negatives regarding just the interest-only type accounts, because now they're going to have to dip into their principal, and when they dip into their principal, variable, it leaves that worry and it leaves that problem of saying I could outlive my money. If I take out too much money from my accounts, yeah, I have that risk if I live too long that I could outlive this money. But I don't want to go into annuitization because if I pass away too soon, then my beneficiaries receive nothing. So that's why income riders became very prevalent, became very attractive, especially in the early 2000s. They were first created through a type of product known as a variable annuity, which states that your account value is going to be tied to variable type accounts, higher quality mutual funds. But if the mutual funds go up, then as long as it's beating out whatever the fees are associated with that account, then you would have gain into your account. If the account goes down, or if the mutual funds go down, well, you're getting drilled with the high amount of fees that comes with variable annuities, and you're getting hit with pulling money out of that account, and also that downward market loss. So it's just that reverse dollar cost averaging that's now at a much higher compound effect in the negative direction, in a downward direction, rather than have that really accentuate your accounts. So the income riders still were very, very powerful, because with a variable annuity you could say, oh, as long as your account value has, or as long as you're in a variable annuity with an income rider, we could provide you lifetime income. But God forbid, if you pass away, whenever you pass away, your account value will still be left to your beneficiaries. Now, the downside to it was there's underlying premise through these insurance companies that say, okay, well, we're going to tack on large amount of fees in addition to the fees that you're already paying with the variable annuities. So therefore, it's going to try to get your account down to zero as fast as possible, so that there's essentially nothing left to your beneficiaries. And yes, you'd still be provided lifetime income, but you're in that same boat as if annuitization were to occur. So that's why after 2008, after we've all experienced this horrible 2008 market crash, and a lot of variable annuities started blowing up, and individuals started really seeing the true colors of a variable annuity, and seeing how it's just a little bit of a growth product, and it's a little bit of an income product, but it's not maximized for just purely growth, or just maximized for purely income. So that's why individuals started gravitating towards a more safer, consistent route of the fixed index annuity with an income rider that allows your account value to have preservation, protection from downward market losses, minimal to no fees whatsoever with that income rider. Majority of them do have a fee, but typically they're only less than 1%. That you could leverage lifetime income, but make sure that there's still the power of compound interest working in a positive direction to leave to your beneficiaries at a later date and time. So let me clear off the screen, and I'm going to re-explain that process. So we understand annuitization and regular annuity components provide lifetime income, but you're surrendering control of your account value. A fixed annuity will provide you a fixed interest rate year by year that someone can live off that interest, and then essentially roll over their principal at the end of that duration of time that they place their money into a fixed annuity. A variable annuity would either go up depending upon how well those mutual funds did, or could crash and burn depending upon if those mutual funds did poorly. So therefore, you had in the early 90s, you had these things known as fixed index annuities that came out that tried to leverage or tried to beat out the fixed interest rates, because interest rates were going to all-time lows. Individuals could therefore place their money into a safe account that says, if the market goes up, I'm going to receive a gain into my account that's comparable to a stock market index, to a positive gains on stock market index. If the index goes down, well, rather than my entire account value going down with it, I'm only going to receive a 0% floor, 0% into your account. So if you have a scenario with a fixed index annuity, and you have, let's say, 10% cap, and this is linked to an S&P 500, and if the S&P 500 gained 12% that first year, well, then it's as if you have a bucket, and you could use qualified accounts such as 401ks that you're rolling over into IRA contracts. You use Roth IRAs. You could use cash accounts. If you sold a house, sold a business, known as non-qualified type of annuity accounts. But essentially, think of that as in terms of a retirement bucket. Anytime that the market goes up, it's as if we're opening up the lid, pouring the gain inside, and then we're closing the lid. Anytime the market goes down, that lid's going to remain closed. So it's just allowing you to have growth, flatline, have growth, flatline, flatline, have growth. So anytime, let's say the next year the market loses 12%, well, then you're going to receive what? 0% into your account. So is that safety and consistency that was set up through fixed index annuities, and then essentially the fixed index annuities, they started stealing or comparing how the variable annuities worked with their income riders. And after 2008, they became very attractive because individuals wanted to have that safety that a fixed index annuity would provide, and also have that peace of mind, that flexibility that they could receive lifetime income through that insurance carrier. So this income rider, sometimes they have a cost associated with it. Sometimes they don't have a cost associated with it, depending upon the different carrier and the different contract that you're in. The point that I'm trying to make is basically saying understand the cons regarding annuitization, understand the cons regarding interest-only accounts, and then also understand that the insurance companies that are offering income riders and lifetime income withdrawals, yes, that's going to protect you or you and your spouse for lifetime income that you could never outlive, and then also have a safe, consistent basis to your beneficiaries to leave some sort of inheritance to your beneficiaries. But the time and time again, individuals make the mistake of not customizing how to set up these types of plans properly. And what do I mean by customization? Well, you have hundreds of different carriers in particular areas that offer annuity product lines. So you might have 4 or 5 different options per company, and hundreds of companies that do that. So you have over 1,000 options on how to choose your specific plan. Based upon if you're in your 50s, there's going to be 3 separate, best offers for you than somebody that's in their 60s or somebody's in their 70s. Or if you're looking to turn on income in 2 years, or if you're looking to turn on income in 12 years, those are 2 completely different routes and 2 completely different types of product lines that you should be going with, at that point in time. So one of the things that we do with my company, Afasi Financial Group, is we have a 1-800 number, and we have representatives standing by to try to help you out understand, whether or not an annuity might be correct for your situation. On top of it, we leverage something known as the Retire Sharp planning system, where we go through all the top hundreds of carriers in your particular area and the multiple strategies to make sure it's specific to exactly what your goals are. First off, if an annuity is not right for you, then you should not be going into an annuity product. If you want to kind of leverage more of the riskiness of the stock market, and you don't want to have that safety aspect, or you're not interested in that, that lifetime income play, then maybe an annuity might not be correct for your situation. But if you are interested in an annuity, you do have to make sure that you're treading lightly, and these plans are customized specifically for your benefit. So for each person that calls in that we run scenarios on average, we go through over 1,200 different strategies, products, and scenarios before we give our top 3 recommendations. Based upon those top 3 recommendations, we're telling you about the pros and cons of each, and we're trying to explain to you, what's the purpose? Why is this company offering you this? What are the cons to going in with this company? Or, what are the pros to it? Why would it make sense for your specific situation? And, we're going to sit here, we're going to educate you, make sure that you're getting acclimated to the process. And, we're essentially representatives of all these various companies. And because we're an independent agency, it allows us to have non-biased opinions and non-biased information to place you specifically with the best company and customize your plan, rather than, just telling you about this one company that's the greatest thing since sliced bread. That's not the way on how individuals successfully retire. So, one of the things, we are A+ rated on the Better Business Bureau. We've always had very good reviews. We've never had any complaints, and it's because of our methodical process. I want you to, if you found value in this video, please feel free to call our 1-800 number. We offer 24/7 customer service. You could give us a call mornings, nights, weekends, holidays, whatever the case may be. We'll have a specialist standing by to, take your phone call and try to help you out best way possible. Once again, my name is Derek Afasi. I'm the owner of Afasi Financial Group, and please make sure to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. Thanks so much, guys.